Hello, everybody. Thank you for being here. Can you hear me okay in the back? Okay, excellent. Maybe we should have called this one How Washington is Reshaping Manufacturing. I was just kind of thinking about that when I looked at that. But obviously, there's a lot of policy changes that have been going on, not just this year, but even historically. And so what we're going to do is just provide some of that economic perspective. That's my job. I'm the economist. And then also the tax perspective. That's Brian's job because he's the tax attorney. So I was trying to think about if there was a good joke like a lawyer and an economist walk into a bar, and I really couldn't come up with one. I mean, as a lawyer, you speak out of both sides of your mouth, and as an economist, you know, on the one hand this, on the other hand that, so I have two hands, so it's like, well, maybe I have two hands to clean up after you're speaking out of both sides of your mouth. But I'm going to go first to kind of provide some of that context about what's been going on with manufacturing. Now, obviously, all of you know it very intimately and individually. So I'm going to provide that bigger picture macroeconomic view about what's been happening. Before we get into that, we of course have to have our obligatory compliance slide, and I just saw Mark Beck, our Chief Growth Officer, walk in, and he's also a narc, so he will tattle on us if we don't show the compliance side. I'm glad I noticed you walk in. But this is for educational and hopefully entertainment purposes only. It's not individualized tax, legal, or medical advice. So it is just for general information. We're going to go through the slides, give our presentation, and then leave plenty of time at the end for questions. Sometimes I'm very easily distracted, that if there's a question, I will go off on just about any tangent possible. So that's why we're going to save the questions until the end. And I do apologize. For some reason, this display makes those lines shimmer. It's quite lovely. It almost looks, it's kind of got this Las Vegas vibe to it. But obviously, a lot of you already know very intimately what's been going on with the manufacturing sector. Effectively, I think over the last 2, if not longer, years, manufacturing as a whole has effectively either been in a recession or just gone nowhere. And there's been plenty of headwinds for manufacturing in general. What this is showing is gross domestic output. So in terms of what's been going on with the broad economy, that's this grayish line here, gross domestic product since 2018. Okay, so decent growth in GDP. That's the market value of all final goods and services that are produced in the economy. So a big, broad measure of macroeconomic activity. When it comes to private activity, because public sector activity is part of that, so just private sector activity, you know, over the last few years, it's grown like 21%. So that's pretty decent growth. Obviously, you had this gigantic decline here, this nice big divot, which looks an awful lot like when I go golfing, what I always leave behind myself. You've got that big divot with COVID, decent rebound, and it's been pretty decent growth, fairly stable, obviously until earlier this year. First quarter of this year, we did see a slight decline in broad economic activity, but then a fairly decent bounce back in the second quarter. Private sector activity has been mostly driven by the service sector, not by manufacturing. And within manufacturing, that's what these two lines here are showing, can break it up into two broad categories. Those that manufacture durable goods, so things that are expected to last 3 years or longer, so cars, washers, dryers, things like that. And then non-durable goods, which would be things that are manufactured that aren't expected to last 3 years, like clothing, food, beverages, things along those lines. And what we've seen is that for non-durable goods, a lot more volatility with that. Biggest reason for that is because of food and also chemicals and things, lots of variation in the output. But the durable goods one has just been kind of like stuck in the mud, it seems like. I think a lot of you maybe kind of have felt that as well if you're in the durable goods sector. In terms of manufacturing as a share of economic activity, it really punches above its weight. In terms of employment as a share of overall employment in manufacturing has been on a pretty consistent decline for the last 30, almost 40 years. But the output, has been relatively more stable. Manufacturing, this is ranking all the different sectors of the economy as far as the share of total output. And manufacturing is actually the largest, just below 14% of overall economic activity. So even though the employment might be closer to like 10% of all employment, it does punch above its weight. And then these are the other sectors that we can break it into. So you have like real estate, rental, and leasing below 12%. You can see like construction, obviously very important, but only above 4%. Going all the way over to like educational services, which is just below 1% of economic output. Okay, so manufacturing, obviously very important and has had its share of struggles over the years. In terms of manufacturing as a category, this is the way that economists, we tend to classify different industries within the manufacturing sector. Right, so the sector is the bigger group, the industries are the specific kind of areas that we categorize them. Food and beverage and tobacco products is the largest portion of manufacturing. I think when most people think about manufacturing, they think about automotives, right? They think about cars, they think about washers, dryers, but actually, manufacturing food and beverage, chemical products, motor vehicles, these are all the different categories that are very important. And obviously for the Wisconsin economy, food and beverage is there's a disproportionate share of food and beverage representation here. Also, as you probably know, manufacturing as a share of employment is larger in Wisconsin than for the nation as a whole. While it's about 10% for the U.S. economy, it's closer to about 15% for the Wisconsin economy. So still, only 15%. But again, it punches above its weight. And some of the challenges that have been experienced, this is the way in which the Bureau of Economic Analysis, so part of the Commerce Department, they look at the different industries and they try to figure out what's the cost structure of these industries, kind of the representative business within each one of these industries. And I thought this was fascinating and really highlights some of the challenges that manufacturing has faced. So the way that you read this, with the bottom part here, that's the gravy, that's the gross operating surplus. It's not profit. It's the operating surplus. Something that's not included in there would be like depreciation. Right? The fact that you have to replace your equipment and all that. And Brian is going to get into some of the changes in tax policy that could affect that as far as incentives to upgrade and maybe lower the cost of doing that. Most of the cost, though, it's quite varied as to what the cost structures look like. The number here, so this 19, for example, for manufacturing as a whole, that is for compensation of employees. So if you think about the revenue or the output that's produced, so the revenue that you get, on average, 19% goes to compensation for employees. Every business is different. Every industry is different. You've got this nice catch-all category, miscellaneous manufacturing, where it's like 39.1%. So that was just one that didn't fit into those nice little categories. But like apparel, leather, and allied products, right? So compensation of employees, 35.4%. So fairly large, very labor-intensive, and that's one of the big costs, right? As you know, in terms of not just the cost of materials, because that's in this burgundy colored one here. That's the cost of materials. Material costs, lots of fluctuations there. Trying to manage that, especially in today's environment with changes to tariffs. Right? That has affected a lot of businesses. What do you import? How have those costs changed? What's your flexibility in terms of being able to source from other countries, perhaps where there's lower tariffs? So variations in the material prices and then tack on to that tariffs has been kind of a pain point, I think, for a lot of businesses. And then the changes in the compensation as well. Over the last few years, we've seen a big increase in wages, which is great for workers, right? And the problem, of course, is that then you need to make that decision about the extent to which do you continue to hire, or do you use more technology or equipment. Now, one of the nice things that has been happening, so despite the increase in compensation costs, is that this is just for the economy as a whole, but manufacturing in particular in the United States is incredibly productive. So for U.S. overall labor productivity, this is services and manufacturing, there are few countries. These are all of the members of what's called the Organization of Economic Cooperation and Development, basically the big economies of the world. The United States is incredibly productive Right. And when it comes to manufacturing, U.S. manufacturing would actually be second on this list. And interestingly, when we're worried about some other countries, let's say, Mexico, their productivity is a lot lower. Their wages are also lower. And there's this direct relationship between wages over time, how that grows, and productivity growth over time. So I'm very confident that, given a fair footing in a fair fight, that U.S. manufacturers can easily compete on a global stage. So some of the things that have been happening that obviously are affecting manufacturing and the economy as a whole, we have tariffs. Right. Continuing to evolve in terms of what's being tariffed, what's not. We know that about 70% of all the tariffs that have been applied so far right now are being challenged in the Supreme Court. They'll be taking up that case in November, hearing arguments that's under where President Trump imposed those reciprocal tariffs under the International Emergency Economic Powers Act. It's being challenged as to whether or not that actually allowed for those. But as a backup, he is likely and has been imposing tariffs called the Section 232 and the Section 301 tariffs. So it's either sector specific, like just, was it today or yesterday that he announced about mid to heavy trucks, right? The tariffs that'll be imposed as of November 1st, I think 25%. So that'll be, that's a Section 232 tariff. So it applies to a specific sector. So applying that to pharmaceuticals, aluminum, steel, all sorts of different goods. And then the Section 301 would be country-specific tariffs. So tariffs against China or tariffs against Brazil. So those, it's very well defined legally. He has the authority to do that. You can like it or not, but he does have the authority to do it. It's those International Emergency Economic Powers Act ones that are being challenged. So I have a feeling that by the time that the Supreme Court rules on it, we'll have all sorts of other sector-specific tariffs rolled out as like a backup plan in case those other ones, more broad-based ones, are struck down. So obviously creating some businesses love them. Others hate them. It depends on, does it affect your costs or does it actually benefit you, shielding you from competition? Then the incentives also that are in place, that this is what Brian's going to get a lot more into in terms of from the tax code. So earlier today there was a presentation from, I think, SVA, the accounting firm, about the One Big Beautiful Bill Act. We're going to be touching on some of those, but specifically as it relates to the incentives that it creates, and also some estate planning opportunities that arise from it, which hopefully you'll find that interesting, especially if you're a small business owner. And the thing that is perhaps not oftentimes highlighted enough are some of the changes in regulations. It's been most obvious recently in the banking sector. You probably heard Fifth Third Bank purchasing Comerica, and likely to be approved within probably 45 to 60 days. Under the Biden administration, those types of approvals would take probably 450 to 600 days. Okay, it's a different regulatory environment. So there is a push towards deregulation, and that's why we titled this one, there's carrots and there's sticks, right? The carrots in terms of some of the incentives, perhaps under the One Big Beautiful Bill, also deregulation, the incentives that arise from if you're being shielded from competition with some of the tariffs. But then the sticks, as far as it can also be a little painful, right? Mostly probably arising from tariffs, especially if you're importing a lot of the inputs into the production process. Okay, so that's the economics part of it. And I didn't have to resort to supply and demand diagrams or anything like that. So I'm pretty proud of myself. I'm going to now pass the clicker over to Brian, the other Brian, the better Brian, to go over some of those incentive effects.
All right, you guys can hear me okay? Yeah, all right. Okay, so I know you guys, some of you saw this earlier today, just covering the One Big Beautiful Bill. I'm gonna tell you where I come from for this stuff so you guys have an understanding of why I wanna talk about certain things. So I've been a tax attorney for 15 years now, but I cut my teeth working with small business owners, doing, maximizing deductions, all those kind of fun things. And so I've seen this stuff over 15 years really pop up regularly. And so it's stuff that just gets ignored because, let's be honest, small business owners a lot of times don't have time to do this. And to be honest, a lot of times their tax advisors aren't actually advising them. They're doing tax prep, they're doing reporting, things like that. And so the company I worked for, just to give you an idea, I worked out of Chicago for a long while of that. And this is all they do all day, every day. They review, a tax preparer's work, and then they go in there and they say, we can save you $100,000, $200,000, $500,000 if you do X, Y, Z. And so my lens is really that, because a lot of this stuff just gets ignored, or it just isn't explained, or it isn't, thought through in the grand scheme of things. So I just want to touch on a couple things today. First off, depreciation changes, and this goes to the incentives that Brian was talking about. I want to start with this too, actually, before I get to there. There are some things that happened in the bill that we didn't include in this. Now looking back on it, we should have, talking about adjusting incentives and things like that. All of the energy efficiency stuff is going away. All the credits are going away completely, which changes whole sectors of the market as far as that stuff goes. So there's a big stick for certain things. But there were some things that help with that, or help mitigate that a little bit at least. First one is depreciation. Changes to depreciation. So the bonus depreciation was really nice a couple years ago, and now it's nice again. So this came through at least the 100% bonus depreciation stuff, which means you can actually depreciate it all in the first year, which is really nice, rather than having to depreciate it over 5, 7, 10, 15, 39 years. Actually, take that back, 39 won't apply here, but yeah, so what was happening is in 2017, they passed the Tax Cuts and Jobs Act. They put this in there at 100%, and then it slowly diminished up until this year where it was 40%. But then they came back through and they passed the bill and they moved it back to 100%. What does that mean? That means you actually get to deduct 100% of certain things, which is really nice. Like I said, for example, rather if you have a $100 piece of equipment and you got to depreciate it over 5 years, $20 a year, that's not great. It's fine. You get to depreciate it. But if you can do it all in 1 year and take the $100 deduction now, that looks a little better. Another aspect of it is the 179. Now, this has always been around. This has always been something that's out there. The cap was really low for a long time, though. And so as a result, you were limited in a lot of ways, essentially. So what they did is they raised that, and that's, again, we get the ability to deduct some of this stuff. And by the way, you can use these two together, which is great. So you get to maximize a lot of that stuff. And the one that I really like is the qualified production property. So this is one where if you are looking to expand as a manufacturer, for example, if you are looking to, you need more space, this allows you to build a place to manufacture and then deduct the whole thing. Usually, if you build a building, you're looking at depreciating that over 39 years, plus some adjustments. But in this situation, you can deduct the whole thing in the year you put it into service. That's huge. I mean, if you need more space, here's an incentive right here for you to build that. So that's the depreciation aspect. Like I said, some of this stuff just doesn't get explained. I like to bring it up and harp on it and beat the drum as much as possible. Another one is research and development. R&D deductions. So you have two different things. You have R&D deductions, which is, versus the income, or you have R&D credits. You get both. And you get to use them depending on what you're doing. They kind of fit together in certain ways. What was going on is you would have to basically spread out these deductions over a couple years. The One Big Beautiful Bill Act, again, allows you to deduct it all in the year that you do it. And what I'd like to do is actually, and the reason why I like to harp on this one is because at least before I read this, before I had read these code sections and studied this stuff, I used to think of R&D as, guys in white coats and beakers playing around with, open flames. The reality is this is a fairly expansive deduction. Like the idea of R&D is very, very expansive. For example, I've worked in the past with companies that were building machines, huge machines. I'm not going to tell you what kind they were because, confidentiality stuff. But essentially the client would come in and say, we have X amount of room for you. We need you to build X, Y, Z, and it has to fit in this place. And it has to do these things. And so they would sit down and they would engineer these things over, however long it took, could be years sometimes, in order to fit these things in the right place. So the process, that's what it is. It's a process using scientific method, essentially using the sciences, in developing a product. You can deduct all those expenses now, currently, rather than having to spread them out over time. So I like to harp on this one because it does get lost in the shuffle a lot. Both of those companies I mentioned, they had no idea that they could use this. They were like, we don't do R&D. That's not what we're doing. We're not doing research and development. And no, you actually are, because you are actually going through a process of developing these products. And as I said, you do have the credits as well, that those go against your taxes. And so they kind of interplay nicely together. All right, and the last one, and this goes to, well, at least in this part of it, the qualified business income deduction. Now, most people here most people here have probably heard of it in some way if you're in manufacturing. I like to talk about this one because of choice of entity. Like I said, my job was to review tax returns, business owners' tax returns, for years and years and years. This deduction was created because they lowered the C corporation tax rate to 21%. So they needed to make pass-through entities competitive, essentially. That 21% tax rate was a lot lower than it had been in the past in certain situations. And so they created this. Basically what this is a 20% deduction against income from certain entities. So that's S corporations, partnerships, sole proprietorships, pass-throughs. It does not apply to C corporations. And so the reason like I said, I like to harp on these things is because I saw recently another new company, another company, they're doing, $5 million of revenue and $1 million, net, and they're still a C corporation. They're owned by mom and dad. They never bothered to switch it off. Yeah, they take the money out using their wages and things like that. But rather than, maybe make an S selection on the entity and taking advantage of something like this, it's just been sitting out there. And now they're trying to sell the business to their kids, for example. And now they have, and this is bad, they got a lot of cash sitting in the business. So when you sell the business to your kid, guess what? You get to sell them the cash, or they have to take it out. Either way, it's going to be painful. And so, if they could have thought about maybe looking at this 5 years ago and really planning around something like this, because this is a really good opportunity, then they, like I said, if they had somebody who was advising them, somebody who was actually talking to them about these things, they would have had the opportunity to maybe take advantage of this. All right, and a couple last things we're going to touch on real quickly. Gift and estate, GST exemptions. So a lot of the stuff that happened in the One Big Beautiful Bill Act was an extension or improvement of what was done in the TCJA back in 2017. One of those things was they doubled the lifetime or the state tax exemption amount. It went from being, and I forget the numbers right now, but it went from being about 5.5 to about 11 per person. On December 31st of 2017, it was 5.5 million. The next day, it was 11 million. Now, that was scheduled to sunset. Basically, at the end of this year, it was going to go back down to half of what it was. So what that means is, with inflation, it was increasing until this year to roughly, 14 million. I like round numbers, so it's 13.99 million, but roughly 14 million. And then next year it would have been 7. And so what the One Big Beautiful Bill did was it actually locked that into 15 million starting next year, which is roughly what it would have been with inflation. So what that means is now we can start planning. Unfortunately, one of the things with it being subject to sunsetting next year, the TCJA was one of the issues is that it was hard to plan for at that point. When you go from having 15 million or 14 million down to 7 potentially the next day, it's really hard to do estate planning, to transfer businesses. Now that we know what that is and now it's been locked in, we really have the ability to take a look at it and say, okay, what can we do to transfer this to the kids? Again, going back to the one client that I was talking to recently, it's, okay, can we gift part of this now? Yeah, now we have the room because we know this company that's worth maybe $10 million. Mom and dad now have, roughly $30 million to use as gifting. So that's pretty powerful. Like our ability to now plan ahead and say, okay, we can do this, X amount this year, some more next year, and things like that. That gives people the flexibility to actually transfer stuff comfortably going forward. And then there's always annual gifting. We're just having a conversation about this. The annual gifting exclusion is $19,000, and it's going to stay that way going forward. So that's always nice. What that means for those who don't know is means you can give $19,000 to whoever you want to, as many people as you want to, and without it being taxed on either end. And it doesn't affect your lifetime gifting as well. All right, and this last one is huge, at least in my eyes. This is one of the biggest ones in the bill. So qualified small business stock is stock of a C corporation. So I mentioned earlier, like S corporations, the qualified business income deduction. There's all sorts of benefits maybe to being an S corporation or a partnership or something like that. Qualified small business stock is actually stock of a C corporation. If you qualify for it, and I'll go through the qualifications in a minute, you get to exclude a certain amount. So right now, they just adjusted this a little bit, but it used to be if you held the stock for 5 years, you could deduct 100% of your capital gains up to a certain level. So you could sell your business potentially, let's say it was $15 million. The cap was $10 million previously. So you could sell your business for $15 million and not pay taxes on that $10 million. There was a qualified small business stock exclusion. And by the way, that's an exclusion. What that means is it's not included in your income at all. So you could exclude $10 million of capital gains. So the qualifications for this are, like I said, C corporation. I'll get into the holding periods here in a second. It has to be an operating business. It can't just be a passive entity. So you can't just buy properties and invest in them or stocks, bonds, whatever. It can't be certain types of businesses. Professionals, for example, it can't be a law firm. It can't be a medical practice. It can't be an accounting firm. It can't be restaurants and hotels. So stuff like that. It has to have a certain level of assets, which that's just got adjusted as well, but it used to be 50 million. Now that's gone up at the same time. So, and what that means is that you can't have those assets, X amount of assets in the business when you issue the stock. So it used to be 50 million, now it's 75. So you can't have 50 million of assets when you issue the stock to whoever it is. And then the holding period, which is the fun part. So previously you had to hold it for 5 years, and you got 100% exclusion. What they did with this is they adjusted it a little bit. They said, okay, well, if you held it for 4 years, we'll allow you to exclude 75% of that. And then if you held it for 3 years, it'll be 50%. Which is a big change. I mean, 5 years is a pretty good lockup, especially for investors sometimes. And so the ability to kind of to get out of this stuff without without holding it for 5 years is a big deal. And that's kind of what I had. Like I said, I harp on a couple little things. I don't really want to beat the drum on everything, but just see. Do you guys have any questions?
Yeah.
I have a question for you. So, tariff is a stick for us right now, the manufacturing company and all that. It's not a whole lot that we buy from outside, but the type of component, copper power that we're looking for is not available to us.
Mm-hmm.
No domestic manufacturers. So we have to buy from either Germany or India. Okay, so it's a big sticker shock that we're passing on to the consumers now. And we're working with them on the price increases. This is a major issue for us. Main challenge for us is how to maintain the profitability.
Mm-hmm.
Okay, revenue is not an issue. The economy is still strong. The business is still there. The profitability is a problem.
Sure.
So that's what we're dealing with right now. Any hints?
So great question. So for those who couldn't hear, so they purchase inputs that are not available in the United States. It's either India or Germany, and they still want to maintain their profitability. So the revenue isn't an issue, and you're able to actually increase the price to consumers. So that helps, obviously, if you're able to pass through that tariff cost. A lot of businesses can't. In fact, a lot of small businesses that I've been speaking to, they are nervous. They don't want to be the first ones to try to hike their prices. They're waiting to see if their competitors are. So it's not like coming out of COVID where everybody was raising their prices, right? So it's very different. So the fact that you have pricing power is really going to be important. What other businesses that I've seen, so if you have to source it from India or Germany, is what else in your supply chain do you have the ability to control, right? So it's kind of like just focus on what can you control. You can't control where you get it from necessarily, but can you control other inputs? Can you control your costs in other ways? You know, in terms of what we've seen some businesses do, especially smaller manufacturers, is to not allow people to work overtime. Right, so kind of adjusting that wage component a little bit more, so trying to cut back on that, or using more attrition, so trying to get people to work a little bit harder, a little bit longer, without them breaching into the overtime part. Although there are some incentives in the One Big Beautiful Bill for overtime pay, right, in terms of not being taxed. So, I mean, my advice is to, you've got pricing power, and that's awesome, because most businesses don't have that luxury. We do see it in certain areas, like, for example, agricultural products. You go to Walmart and you see banana prices. They were able to pass through those price increases or the tariff costs pretty directly, but then in others, like Japanese manufacturers selling in the United States, they weren't able to, they didn't hike their prices at all, so they just ate the tariff. So the extent to which you have that flexibility, maybe leaning on your suppliers to get them to share in the cost, that's probably the best thing you can do.
Yeah, there is some pushback from customers that we were seeing too. The only question I have for you is, with all these costs going up, is our buying power lower?
Yeah. It is, yeah, good question. In terms of, is your buying power lower? And that really does feed into at the consumer level or the business level as far as inflation, right? If you have a certain amount of wage, if you're making $100 and all of a sudden the cost of living has gone up, because inflation, remember, is this continuous increase in prices. So if you have deflation, a decline in prices, that would be great, but that rarely happens. Most of the time when you have lower inflation, the prices keep rising, it's just at a slower pace. And so are your wages rising faster than inflation? And in the United States as a whole, when we kind of look at a longer trajectory for your typical worker, real wages have been going up. Real median earnings, real median weekly earnings, so kind of looking at the amount that you make, multiply it by the hours, adjusted for inflation, it has been on a steady increase. Now, there was a huge jump, a spike higher in COVID with stimulus checks. But so if you kind of smooth that out, it still has been rising at probably close to about 2 to 3%. That's faster than what we had probably about 20 years ago, when it was closer to like 1%. So even the most salient or visible prices tend to drive our perceptions of inflation. So you see food prices go up, you see gas prices go up, you think all prices are going up. But in fact, they're not going up quite as fast as what people's wages are. Now for businesses, of course, then I think it feeds into the idea of when your costs go up, because either compensation costs, operating costs, input costs, are you able to pass on that to your final buyers of it? And that's, again, where that pricing power comes in. But yeah, in general, I think most people are shocked to find out that their wages actually have been rising faster than the overall price level. Part of that too is, I think, when we get a raise, we think it's because we're good people, we're good workers, we earned it, we're working harder. We don't really think about how, it's relative to prices. That's more, we kind of take that to perspective, oh, that's happening to me, right? As opposed to, this is what I earned. Yeah. Yes, sir.
Could you just differentiate between bonus depreciation and 179? Like, what do you use one over the other?
Sure. So bonus depreciation is, well, okay, I'll start with this. There isn't one way to do it. Usually what you want to do if you're going to use both is you want to use, 179 up to a certain point, and then we take the bonus depreciation and keep pushing that up. There is no cap on bonus depreciation, so you can just run with that. So what we have with bonus depreciation is it's for stuff that's, has a depreciable life under 20 years. So it applies to a lot of different things. You can create a loss with it, which is nice, which is why I say you start with 179 usually first, and then you put the bonus depreciation on top of it. And then as far as, well, and then with 179, you have a certain level that you can go to when you use it. And then it actually starts, you start losing it by like $1 per, once you get over 2.5 million, you start going the other way and you end up losing it if you buy too much stuff. I don't want, without going into details, but yeah. So what you do is you kind of start with the 179 if you can. If you're going to use both, and then you use the bonus. Yeah, that's kind of it, really. I mean, that's like I said. There's not really a way to do it. Oh, the other thing is with bonus depreciation. If you pick one thing, so if you say we're going to do this certain piece of equipment that has a 5-year depreciable life, now everything that's 5 years has to be bonus. You have to use bonus depreciation on it. So it doesn't matter if you didn't want to do it. It's going to apply anyways.
So Brian, does that mean the section 179 you can like pick the specific item?
Yes.
Whereas with the bonus depreciation, it's anything in that category.
Yes.
Yeah.
Yep.
That's why you hire people like him to figure it out. Right? What's the optimal mix and match?
Yeah.
So I work for a general contractor here in southeast Wisconsin. In regards to new builds for manufacturing, we're seeing a lot of work in food and beverage. Are you seeing any other growth in other industries that you predict or see potential in the area?
Yeah, so food and beverage obviously being the largest kind of industry within manufacturing, not surprising, especially within Wisconsin. I would definitely expect to see that with the incentives now with the One Big Beautiful Bill, incentives there. Obviously, there's also then data centers. That's, I don't know if you want to classify that as manufacturing necessarily, but in terms of a general contractor to build something, right, huge growth in that particular area. And then I'm just curious the extent to which we're going to build out then the infrastructure around that, especially with electricity generation. That kind of remains to be seen. I think that's also somewhat controversial in terms of with some of the public hearings that we've seen about when you build a data center, does that mean everybody else is going to pay higher utility bills, or are they footing the bill? But some of the other, there's in terms of the automotive is going through, I think, a transition period because of the removal of those electric vehicle credits that ended as of the end of September, right? Where now, almost going back to the traditional internal combustion or the hybrid vehicle, where there's now the incentives to continue with that in terms of the all the different parts to the supply chain. Most of the things that I've been hearing about from smaller businesses has been more food and beverage, but then also specialty equipment manufacturing. Those are the two big ones that stick out. And then, of course, the data centers.
In terms of tooling that's made overseas and then worked here, say like plastic injection molding, the cost to get it made over in China is less than obviously getting domestically made. Is there anything in the new legislation that helps with that or anything that that?
So I would say that the tariffs obviously are going to affect that, but my understanding is that even with the tariffs, it's still cheaper to import it as opposed to manufacture it here. Then it gets to, I think, the research and experimentation, some of the incentives there for, a lot of that, if it's custom made, right, that can involve some R&D. That is specifically for domestic R&D as opposed to foreign R&D. So it's also, do you contract this out or is it part of the same company? I would say that's one of the areas. So obviously the ability to build a plant and depreciate that, the equipment, those are some of the incentives. It's a fairly blunt tool though, so I wouldn't say that it's really specific where I would imagine that'd be a huge game changer, but maybe it tilts the scales a little bit. I don't know what you're seeing in terms of cost differential. If anybody in the U.S. is becoming more price competitive now, at least maybe they hike their prices, but are they relatively more competitive compared to some of the Chinese manufacturers?
Yeah, you see obviously the differential on the front end, and then whenever there's rapid tariffs, even an expedited freight from China is still a cheaper solution to get it from China.
That, yeah, okay, so one of the things going on in China too, though, is the government is cracking down, and I forget the exact name that they use for it, but for many years, they were just focused on volume, not profits. And the government has just recently said that they want the companies to focus more on being profitable as opposed to just building whatever you can as much as you can and getting the market share. That's because they notice that they're competing so fiercely with each other on price domestically, it's causing deflation, it's also creating all sorts of economic distortions. Now, does that mean, though, that that's going to affect how they compete globally? Probably not at first, and it's something that is likely to play out over time, but that might be something interesting to watch. I'm not sure if there'd be anything domestically that would be affecting it, but perhaps something over in China, their change in policy, maybe we'll see some change in corporate behavior over there.
I agree with this question. For example, injection molding tool here to make it in the United States, it's $50,000 roughly. Same thing you can get in China is like $10,000.
Wow.
So if you want to support manufacturing here, that's where some concession needs to be given to support manufacturing.
Yeah.
It's difficult to develop a supply here in the U.S. with that much delta.
Yeah, that is huge. Yeah, they could tariff it 500%, and it would still be like, well, then it's maybe I want to do it here. Yeah, that's incredible. Yeah.
Do tariff regulations focus on where the tool was, the stamping tool?
Mm-hmm.
If it was made in China as opposed to made in the US and shipped to China to stamp the parts, tariffs would be the same, or would it be cheaper on that?
Let's see. So the way that it's applied is the value as it comes into the United States, right? So if you do part of it, send it there, and then stamp it, bring it here, it's still based on the total value. Now it's the value add, I think. So you've got the reimportation where, okay, what did you export? And then the value added as it comes in. So it should be based on the net amount as far as the value added there. And that would be kind of an interesting thing. It's if you ever want to read a really interesting book, The Travels of a T-Shirt, as far as it tracks how T-shirts are made. You've got the cotton fields, mostly in Lubbock, Texas, and then how it's shipped overseas, and then it comes back, and then it goes back overseas, and then it comes back, and the travels there. It's really a fascinating read. There's, in fact, I think somebody made a documentary about it. Then you can find it on YouTube. But, yeah. Any other questions? No? Well, thank you very much. Really appreciate it. Enjoy the cocktails afterwards. I should have started off with, we're the only things separating you from the cocktail hour. So now you are free, I think, to get be first in line for those. So thank you, everybody, so much.
Thank you.